Welcome guys to a new video. In this episode, I'm gonna share with you a full trading plan of a profitable model that repeats every single week. Alright, the model I'm gonna share today will repeat itself every single week. Now, before we start, if you find my content educational, please consider to subscribe. That would motivate me to generate more educational videos and drop more trading models for you guys. Now let's just get started. So our trading model for today is called TGIF. Thank God it's Friday again. Alright, and as the name suggests, this model, this setup will play out only on a Friday. So now this could be your only model, so you could only trade during Friday because it will repeat every single week. Or you can add it to your arsenal of strategies. So maybe you have already have a strategy and you want to add another model to it. So this is your way to go. So the structure of this video will be like this. First of all, I'm gonna walk through the logic behind this model. So you want to know the logic behind it, why it should work and why it shouldn't. The next thing, I'm gonna show you visuals. I'm drawing visuals on the chart so you will understand better. And the third thing, I'm gonna show you live examples from this week price action and last week and previous weeks. I'm gonna show you then the trading model, the full trading model, and how to apply it on those examples. So let's just get started. So TGIF. Now, the logic behind this model. On a trending week, whether it is bullish or bearish, that doesn't matter. The market will likely to retrace by Friday. I made a typo here, so forgive me guys. So the market will retrace by Friday. Now, what do we mean by that? Let's go to the chart and I'm going to show you. So, for example, you have here the market from Monday, so this is Monday, all the way to Thursday. It has been trending on one direction, in this case bullish. So on a Friday we want to expect a retracement. So Friday we want to see bearishness, meaning we want to take a sell setup, a reversal setup, right? Maybe like this through the close at Friday PM session. Now how true is that? So this is always like this. Do we always see retracement? Yes, 90% of the time we will see this retracement right here, and I'm gonna show you. So there's a concept taught by ICT called open, high, low and close, or open, low, high and close. Now it looks like this. So excuse me. First of all, we have the open. This is the open. So the market on Monday, so this is a weekly chart, alright? This is a weekly candle. And this can be applied on any candle, but for the moment, let's say this is a weekly candle. So first of all, you will see here the open. Price will open from here on Monday. Then it will print the low of the day. The low of the day can be, the low of the week can be print out on Monday or Thursday or even Wednesday. That doesn't matter. We don't focus on this one for the moment. Next, you have the high of the day. again the high of the week. And lastly, the close. So the market will be like this, the week. First of all, you have the open from here. You will see a bearishness. If you are anticipating a bullish week, like here, an expansion, and then you will see a retracement. This retracement here is likely to be happen on Friday. All right. So this retracement like we have here, it will likely to happen on Friday. Now, let's look at the chart, and this is Euro USD on the weekly chart, and let's see if this is true. For example, let's say this candle right here. We will have this was from 14th of June 2021. Now, I can see that the market was bearish. First of all, this is the open. We print out the high of the week, then expand lower, and then you can see here we have a retracement. So we do not close at the high of the week, at the low of the week, but rather just above it. You can see here. Let's go to a bullish example. So this weekly candle, you can see the open here, print out the low of the week, then expand higher, and then close below the high of the day. Every single candle is like this. All right, 90% of the candles is like this. For example, here, open, you have this a little bit of wick creating the low of the week, expanding, and then creating the high of the day, and lastly retracing. All right, retracing below the high of the week. Here also, go to your chart and identify these. It's everywhere, and not only on the weekly candle, on the daily, on the 1 minute. Every single candle is like this, but this model will focus only on the weekly candle. Now, so this setup repeats itself every single week, but only if you have a watch list of 4 to 6 pairs, because you will not find a trending. If you have only one pair, say Euro USD, it will not trend every single week in one direction. Sometimes it will consolidate during the week. All right. So if you have like 4 to 6 pairs, 7 pairs, 5 pairs, you can. So by Thursday, all right, by Thursday, the day before Friday, you can, or 2 days before Friday, you can go to your chart, go to this watch list of 5 to 6 pairs, and identify the trending ones. So which pair was trending in one direction. So maybe from that watch list you can extract only 2. The next thing to do is to anticipate that reversal on a Friday. All right. So our objective from this model is to ride the retracement move. That retracement from here, that retracement, and this retracement, we want to ride it. We want to capitalize on that reversal move, that close above the high, close below the high or above the low. I hope it was clear. Now let's go to the trading plan, and I'm going to show you live examples and how to apply it. So the trading plan. First of all, the first thing to do is to identify a pair that has been trending during the week. How can you do that? For example, let's go to the 1 hour. I like to identify the trending pairs from the 1 hour. So the first thing to do is you want to put a horizontal line, a vertical line on Monday. So the beginning of the week, midnight. So you can see here that this pair, Euro USD, has been trending the whole week on a single direction, which is bullish. can see here. Next thing is you want to put a vertical line on Thursday, on midnight Friday. So here you can see that it has been trending all week. Now you want to see a reversal. You want to see a retracement and close by the end of Friday. All right, and you can see here we have been expanding, printing the high of the day on Friday, and then retracing. So this move is our model. Model is based on this move right here. So the first step is checked. We have identified a pair that has been trending during the week. Now, what is the next step? You want to see a liquidity rate. All right, you wait for a rate on liquidity. As the says go, no rate, no trade. So a rate on liquidity is mandatory, guys. Now, what you want to do is go to the lower time frames, like the 15-minute or the 5-minute, and identify that rate. In our example here, you can see this is midnight Friday. Price rated this. There has been a rate here, creating the high of the day. All right, so the liquidity rate is confirmed. What are the next thing to look for? So we have identified a pair, a trending pair. We have identified a liquidity rate. The next thing is you want to see a displacement. All right, what is a displacement? A displacement is an energetic move to the downside or the upside, breaking market structure. Now, on our example, we want to take shorts. Then you want to see the displacement on the sell side of the curve. You can see here a displacement right here. Displacement, you want to see an energetic move, meaning big candles, and you want to see displacement leaving a fair value gap. A fair value gap is mandatory, guys. You want to see a fair value gap on that displacement. So you want to see a move, a rate level liquidity, then a displacement, energetic displacement, breaking market structure shift, and you can breaking market structure, and you can see here that we have broke this structure right here, this recent swing. Now we have the first three conditions are met. What are the next thing to do is entry. The entry you can enter on a fair value gap, breaker, order block, or optimal trade entry. So you see here that we have this fair value gap. So you want to enter either from this fair value gap right here. Once price touches, now you can take the sell, or you can enter from this high probability order block right here. And guys, I'm going to share with you a video next time to talk about high probability order blocks and what makes an order block high probability. I'm going to show you a mechanical plan, a mechanical approach to identify those high probability order blocks. So you can either enter a fair value gap or an order block. All right, or you can enter an optimal trade entry. What is an optimal trade entry? Is this optimal trade entry, OTE, is like this. So you want to run the fibs from the high of the displacement to the low of the displacement, and you want to enter on the 618 level or the 78 level. All right, 786. So that is the OTE. It will give you high risk to reward, but you will not catch the trade every single time, because most of the times the price will not retrace to that level. So if you are conservative and you don't want to miss the trades, you can take the entry on the fair value gap. If you want a higher risk to reward, you can take the entry on an order block right here, and you can see it will give you higher RR. Now The entry, all right, the entry, you want to take the entry, the trade during London or New York. And keep in mind that is New York time. So UTC -4, right here. So the trade, you want to take it. ICT teaches time and price, guys. All right, time and price. So you want the time to be on your side. Take the trade either on the London session or New York session. Anything outside these two sessions, it is low probability. And as you can see, the next thing is the take profit is at least guys 2RR. So for example, you take the trade on this high probability order block right here. The stop loss will be on this. You can target this liquidity from here, or you can target this fair value gap right here for 3R or even maybe 4R. So, and this was from yesterday, guys. So this is recent. As you can see that this model repeats itself. Now let's go to another example right here. I believe I have another example. So we have a bearish example right here. Again, you want to put a vertical line on the beginning of the week, on Monday. The next thing is put a vertical line on midnight from Friday. All right, you can see the first condition of our trading plan is met. Identify a pair that has been trending. You can see that this pair was trending all week, all the way to Thursday. Now we want to see a retracement on a Friday, so you want to take longs on a Friday. You want to go maybe to the 50 minutes. You want to see a liquidity rate. So we have this. So this is Friday. This move right here is irrelevant to us. We don't want to take this move right here. So although this move is on the side we want to take longs, and this move is long, but there has been no liquidity taken. You can capitalize on this one right here, but I prefer the liquidity to be taken first. So we wait. We don't take this trade first. We want a liquidity to be taken. You can see here that price here took liquidity from here. So you have taken liquidity. The next thing is you want a displacement. You can see after taking this liquidity, we have this displacement right here, a nice displacement. Now you want to enter again on a fair value gap, a breaker, an order block, OB, any PDRA. That the entry actually doesn't matter, because when you have direction, when you have the right direction, then you can enter from any place. Now you can see we have a fair value gap right here. But as you can see that price have never touched this fair value gap. This fair value gap stayed open. Now why this fair value gap stayed open? I have discussed this on a previous video. You can watch it from here. I have I'm gonna give you you can click on this card right here and you will know. We have this balance price range. You have a balance price range here. This is a newly introduced PD array. When you see this PD array right here, you anticipate this fair value gap to stay open. Alright, and as you can see that price hit our PD array and then continue higher. I'm gonna show you guys one last example. So as you can see, we are bearish. We print out the high of the day like I showed Like I showed you in previous visuals, we print out the high of the day on Monday, we open, print out the high of the day, and then what we have, an expansion lower. So you want to see a reversal, some kind of a reversal during Friday. Now you can see the price took liquidity from here, taking liquidity, displacing higher, leaving a fair value gap right here, low or maybe here, and you can target this liquidity from here, giving you 2R, clean 2R. Now what I want you to do, guys, is to go backtest this strategy. On the next video, I'm gonna do a backtesting session of this strategy and I'm gonna share with you the results. I don't want to make this video any longer, so I'm gonna do it on a different video. I believe we have reached the end of this video. If you have any questions, you can DM me on Twitter or leave a comment down below and I'll be happy to answer you. So good luck and happy trading.